The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Politicized Financial Regulation and its Impact on Consumer Credit and Community Development. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for 5 minutes to give an opening statement. Today's hearing will explore recent actions taken by the federal regulators that will limit financial options and restrict access to financial services, particularly through mandated fee caps and price controls. The Biden administration is using would-be, quote, independent regulators as political agents to circumvent Congress and drive leftist transformations in financial regulation to the detriment of consumers and communities. The coordinated effort between the Biden administration and the CFPB to eliminate so-called junk fees is a clear illustration of this effort. As a concept, junk fees is not legally defined, and the Biden administration has failed to outline any illegal activity taking place regarding fees. They are leaning into the lazy narrative of corporate greed. To be clear, fees serve a purpose, and I support proper disclosure and discerning use of them. Today's hearing is particularly timely given the release of the CFPB's misguided credit card late fee final rule earlier this week. With its finalization, Director Chopra abandoned any notion that the CFPB is an independent regulator. In deciding to finalize the credit card late fee rule, nearby President Biden's State of the Union address, the CFPB is showing how politics and not consumer protection drives the train under Director Chopra. Commentators on the proposal should be appalled that their thoughtful critiques were conveniently tossed aside in favor of political considerations in an election year. All Americans should be outraged that the cost of credit will skyrocket and access to it will be meaningfully restricted in the name of politics. The credit card late fee rule punishes borrowers who pay on time to subsidize those who don't. The rule significantly reduces the penalty fee that financial institutions may charge on delayed payments. This rule encourages borrowers to not worry about paying on time. Delinquent payment costs will be socialized, with late payer costs transferred to all other consumers through higher interest rates and less availability of credit, including for low and moderate income borrowers. Evidently, in the eyes of the partisan CFPB, consumers should take on credit card debt with no fear of consequences if they don't repay. And financial institutions should extend credit with no ability to hedge against that risk and certainly no ability to profit from having taken that risk. Not only is this junk economics, but it is dangerous for consumers' financial security and the health of our financial institutions. It also misguidedly tracks with Democrats' desire to gain increasing control over financial institutions and turn them into public utilities. This flagrant act of political gamesmanship, in addition to violating the Administrative Procedures Act, demonstrates why we must rein in the authoritarian CFPB. Fortunately, this fact has not gone unnoticed. The funding mechanism of the CFPB is currently being questioned in the Supreme Court due to its double insulation from congressional accountability. If the CFPB is going to operate as a political arm of the administration, then it must also be answerable to Congress through the appropriations process, as with every other non-independent agency. Today, we will also discuss the need to clarify standards for enforcement actions brought by the CFPB under the Unfair, Deceptive, or Abusive Acts and Practices, or UDAP Act, in order to provide clarity for financial institutions. Uncertainty in regulatory expectations or meaning leads to fewer choices, less innovation, and higher prices for consumers. The much-needed step of defining abusive acts and practices will instill the clarity and certainty needed to foster a more dynamic and inclusive consumer financial market. Other recent proposals from the rogue CFPB that weren't reviewed during today's hearing include the Community Reinvestment Act final rule and the new CDFI fund certification process, both of which could have a major impact on how financial institutions can continue to serve their communities. Banks and credit unions compete every day to attract and maintain customers and members. They do not need the federal government encroaching in their business practices or trying to dictate relationships and control prices for them. One-size-fits-all regulations are bad for consumers and bad for our financial system. Price controls throughout history are a known recipe for disastrous consequences for the public. Competition is the best consumer protection. Choice is the best consumer protection. And the CFPB seems to be in the business of eliminating competition and choice. Therefore, it is our duty to ensure the financial laws and regulations foster innovation and competition to ensure that all borrowers have the opportunity to access affordable financial products and services. The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, the gentleman from Illinois, Dr. Foster, for 4 minutes for an opening statement.
Thank you, Mr. Chairman, and to our witnesses. Democrats appreciate and support the power of free markets as the engine of growth and wealth creation in our country. There is no better evidence of that than the 16 million small businesses that have been created under Joe Biden, the best record of any president in history. But we also understand that all markets do not automatically work perfectly by themselves. If businesses are competing, not on the basis of providing the best product at the best price, but on the number of surprise and junk fees that they can unload on unsuspecting consumers, that is not an efficient market. The solution is transparency and standardization of those fees so consumers can make their choices accurately. And if consumers are trapped in inferior financial products by the very high costs and difficulty of switching to a new vendor, then that is not an efficient market. And the solution is account portability and open banking. There's also systemic risk. When I was first elected to Congress in 2008, our country was in the depth of a financial crisis. And as we unpacked the circumstances that led up to it, we found that millions of Americans had taken on loans they did not understand and could never repay, and that led to systemic financial collapse. And we also saw that the responsibility for consumer protection had been spread across multiple federal agencies, and it was clear that those efforts had fallen short. So we determined it was necessary to create the Consumer Financial Protection Bureau to consolidate those efforts within one agency that would have a pure focus on consumer protection. I was proud of my work to help create the CFPB through this committee's work on the Dodd-Frank Act. And since the enactment of the Dodd-Frank Act in 2010, the CFPB has fulfilled its mission to protect consumers from unfair, deceptive, or abusive practices in financial markets, despite coming under constant attack. The CFPB has secured more than $20 billion in relief for harmed consumers, $4.1 billion in penalties for violations of the law, and millions of responses to consumer complaints, all while responding to a rapidly evolving financial system. And while efforts are being made to undermine its funding and organization structure, the CFPB is overwhelmingly popular among U.S. consumers, with an estimated 82% of Americans supporting the CFPB's mission, including 77% of Republican voters. So if this is politicization, the American public is winning. In 2022, the CFPB launched an initiative to eliminate and reduce junk fees. These hidden, inflated, or back-end fees cut into American savings, preventing some Americans from accessing the banking system altogether. The Bureau is moving to examine emerging financial technologies like artificial intelligence and peer-to-peer payment services, while advancing a pro-competition agenda to open banking that will improve consumer choice and give consumers greater control over their personal financial data. The Bureau's proposed Section 1033 rulemaking aims to limit the data that financial firms can collect on consumers, establish new protections regarding the use of that data, and make it easier for consumers to walk away when another financial institution will serve them better. That is competition. With all regulatory proposals, it is essential for regulators to engage with consumers and business advocates to achieve the best results. And I encourage the Bureau to continue its engagement with these parties so that we may achieve sustainable positive outcomes for the American people. Today's hearing will discuss many of the CFPB's recent efforts to protect consumers and those of the prudential regulators. In October, banking regulators finalized the most substantive update to the Community Reinvestment Rules since 1995. This rule made important improvements to the CRA that will encourage lending and access to credit in low and moderate income communities, provide additional clarity on which activities qualify for CRA credit, and take steps to modernize the CRA in the age of mobile banking. As our financial system evolves and consumer preferences change, the CFPB and prudential regulators are right to update their policies as necessary to continue to protect consumers. I look forward to hearing the views of our witnesses on these issues and discussing how recent proposals can affect American consumers, banks, and credit unions. Thank you for joining us, and I yield back.
The gentleman yields back, and today we welcome the testimony of Nicholas Anthony. Mr. Anthony is a policy analyst at the Center for Monetary and Financial Alternatives at the Cato Institute. We also welcome my fellow Kentuckian, Karen Harbin, and if you'll just give me a little bit of indulgence and let me elaborate on Karen a little bit. She's the president and CEO of Commonwealth Credit Union on behalf of America's credit unions. She's a real leader in our community in Kentucky. Her credit union and Karen personally, very, very philanthropic. Her credit union has been on Forbes' America's Best in-State Credit Union list 4 times since 2018. It continues to be recognized as a best place to work in Kentucky, and most recently was named by Newsweek as one of America's best credit unions for 2024. Karen currently serves as the board chair of the Central Kentucky American Heart Association, board member of the Baptist Health System Foundation, and the chair of Shriners Children's Lexington Corporate Council. The Commonwealth Credit Union recently made a very generous donation to Eastern Kentucky University, where they're training the next generation of cybersecurity experts in financial services. And we just really appreciate Karen's contribution to this hearing. Lindsey Johnson joins us. She is the president and CEO of the Consumer Bankers Association. And Santiago Sueiro, Mr. Sueiro is the senior policy analyst at Unidos US. We thank each of you for taking the time to be here. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. And with that, Mr. Anthony, you are now recognized for 5 minutes to deliver your oral remarks.
Chair Barr, Ranking Member Foster, and members of the subcommittee, thank you for the opportunity to testify at today's hearing. My name is Nicholas Anthony, and I'm a policy analyst at the Cato Institute Center for Monetary and Financial Alternatives. The views that I express in this testimony are my own and should not be construed as representing the official position of anyone else. Whether it's when we're turning in a library book that fell behind the couch or paying off a credit card balance after hitting a rough patch, paying fees is never fun, but price controls hurt the people they are intended to help and create needless government intrusion into businesses. Yet over the last 13 months, the Consumer Financial Protection Bureau, or CFPB, has proposed controls for credit card late fees, overdraft fees, and non-sufficient fund fees. These proposals have been central to President Joe Biden's re-election campaign as part of his war on junk fees, or perhaps more accurately, his war on prices. In fact, the president will likely further promote these restrictions at tonight's State of the Union. That's why today's conversation centers on how using financial regulation for political gains can negatively impact consumer credit and community development. With that said, today's conversation is not a novel one. It has long been understood that price controls lead to negative, albeit unintended consequences. For example, Paul Samuelson, the first American to win the Nobel Prize in Economics, warned Congress in 1969 that setting price controls on interest rates would, quote, result in drying up legitimate funds to the poor who need it most, and will send them into the hands of the illegal loan sharks. Thanks to Samuelson and many others, it's now commonly understood that price controls are a bad policy tool. And it's because of that understanding that the CFPB's proposals have been met with a chorus of objections from economists, industry groups, members of Congress, and others. Yet, the CFPB remains committed to restricting these services in what will likely secure short-term political gains at the long-term expense of both the financially vulnerable and secure. There's no denying that price controls initially result in lower prices. Likewise, there's no denying that lower prices would likely win points at the polls when many Americans have been experiencing the highest inflation in their lifetime. The problem lies in what happens next, as the price controls result in either shortages or higher costs elsewhere. So on one hand, people could lose access entirely as it becomes no longer economically viable for businesses to continue to offer the restricted services. On the other hand, people could face increasing fees for other services as businesses attempt to recoup losses. Yet, this war on prices is not only misguided due to a misunderstanding of economics, it also fails to acknowledge the changes taking place in the market. Researchers at Unidos found that overdraft fees fell by 68% between 2008 and 2023. Likewise, researchers at Bankrate found that overdraft fees fell by 11% between 2022 and 2023. In fact, even the CFPB has recognized this trend. In a May 2023 report, the CFPB found that revenue from overdraft and non-sufficient fund fees, quote, for the fourth quarter of 2022 alone was approximately $1.5 billion lower than in the fourth quarter of 2019. Reflecting on these trends, the Federal Reserve even reported, quote, competition from other banks and non-bank providers, such as fintech firms, has arguably affected overdraft practices more than anything else. For example, many banks have changed their overdraft practices extensively to either eliminate or reduce fees, and mobile banking has made these cheaper options more accessible than ever before. So these proposed restrictions seem to be unwarranted, to say the least. To be clear, there should be consequences if banks create fraudulent transactions to then initiate a fee that otherwise wouldn't have occurred, or if banks permit overdrafts after a person opts out of this service. However, so long as fraud is not occurring and people can freely opt into and out of these services, the government should stay out of the equation, especially since price controls hurt the very people they are intended to help and create needless government intrusion into businesses. Thank you for the opportunity to testify, and I welcome any questions that you may have.
Thank you. And Ms. Harbin, you are now recognized for 5 minutes.
Thank you, Mr. Chairman. Good morning. I'm Karen Harbin, President and CEO of Commonwealth Credit Union in Frankfort, Kentucky. We are a state-chartered credit union with over $2 billion in assets and 17 branches in the Central Kentucky and Louisville metro area. Thank you for the opportunity to be here today to talk about how recent financial regulations threaten to hamper our ability to serve our members. Unfortunately, some of the recent actions by regulators, such as the CFPB, have credit unions facing a tidal wave of new burdens and regulations. I want to start by noting that regulations do not exist in a vacuum. My colleagues in the credit union industry feel as though they are dying a death of 1,000 cuts. Their revenue on all fronts, from fees to credit card interchange, is under attack, and their costs to comply with ever-increasing regulation continue to mount. Credit unions want regulators such as the CFPB to know that they embody pro-consumer relationship banking, but they feel the Bureau is uninterested in hearing how difficult this is. A major concern is the CFPB's recent initiative against junk fees. All fees are not the same. This initiative has been mislabeled, with the CFPB calling several lawful payment incentives junk fees. These fees bear no resemblance to the type of surprise hotel, ticket, and airline fees referenced by others as junk fees, and in contrast are all subject to comprehensive laws and regulations that include clear and conspicuous consumer disclosures. Mislabeling payment incentives for regulated financial products and services will cause credit unions to no longer be able to offer these products and services to vulnerable communities. We also have serious concerns about the new CFPB proposed rule for overdraft credit. We are concerned that the proposed rule may inadvertently undermine the ability of smaller financial institutions like ours to offer services that are critical to our members' financial well-being. Like numerous other credit unions, Commonwealth Credit Union offers an overdraft protection program to our members. Our members tell us they want and appreciate this service, and they don't object to paying a fee. In fact, we work with members and refund fees when we can. Even with the proposed exemption in the rule, market pressures will necessitate that smaller credit unions alter their overdraft programs in response. Without the ability to benefit from the same economies of scale that allow larger institutions to weather a reduction in fee income, these changes could make it unsustainable for smaller institutions to offer overdraft protection, disproportionately affecting those who rely on it the most. The uncertainty surrounding the abusiveness prong of UDAP and how the CFPB interprets it continues to be a source of concern for credit unions. We are troubled by the recent proposed rule prohibiting NSF fees on instantaneously declined transactions. We would rather see the Bureau issue a rulemaking to further define the abusiveness standard and work to ensure an equitable framework that recognizes the role of financial responsibility for consumers as much as it does the responsibility of the financial institution. This would give financial institutions confidence in knowing whether or not an act or practice is abusive and would allow the entities that are governed by UDAP to better understand their obligations. There are also concerns beyond the CFPB. The Fed's recent proposed changes to the debit interchange rule, Reg II, are seriously flawed and based on the selective reading of narrow and incomplete data. The board also claims that the proposal should lower merchants' costs and that they will pass those savings on to consumers. This data shows it did not happen in 2011, and it would not happen today. If finalized, this proposal stands to cause serious harm to consumers. If the board will not halt this effort, we urge Congress to step in and pass the Secure Payments Act. In conclusion, the regulatory burden on credit unions, whether from the CFPB, Federal Reserve, or the NCUA, continues to increase. Credit unions, including mine, do not boast the massive earnings of big banks, but our impact lies in our genuine commitment to serving communities. We are not here to merely facilitate financial transactions. Our goal is to empower, educate, and uplift our members, ensuring their financial well-being. Regulatory overreach is harming our ability to do this, and we urge Congress and regulators to take action to reverse this trend. Thank you for the chance to be here today, and I welcome any questions.
Thank you, Ms. Harbin. And Ms. Johnson, you are now recognized.
Thank you, Chairman Barr, Ranking Member Foster, and members of the subcommittee for holding this important hearing and for the invitation to testify. My name is Lindsey Johnson, and I'm the President and CEO of Consumer Bankers Association, America's only trade association exclusively focused on retail banks. My testimony focuses primarily on concerns about regulations that will have significant impacts on retail banks and their customers, many of which are being advanced by the Consumer Financial Protection Bureau. Let me be clear from the onset. CBA and our members support strong consumer financial protections. The political shifts at the CFPB have been seismic from administration to administration, and to some degree, Bureau policy will inevitably reflect differences in political philosophies. However, the Bureau's recent actions have raised important questions about whether it's prioritized politics over people. As set out in more detail in my written testimony, CBA believes three tenets cannot be compromised. First, the Bureau must follow the law. Second, facts matter. And third, regulators need to consider the cumulative impacts of all these regulations on banks and also the consumers that they serve. Let me explain each in turn. First, the Bureau must follow the law and respect the limits of its own statutory authority. The Bureau regularly penalizes legitimate businesses in the press without offering basic due process opportunities to rebut the Bureau's claims. In other cases, like its push to create an American version of Europe's open banking framework, the Bureau far overreaches its authority. These changes are of such economic and political significance, they're typically reserved for Congress. In 2022, the Bureau attempted to rewrite 50 years of fair lending law without seeking public comment or coordination with relevant stakeholders. CBA members support objective, clear enforcement of civil rights and fair lending laws, but the changes the Bureau made to the exam manual represented an enormous self-expansion of the agency's authority and stood contrary to law. Thankfully, a federal court agreed with CBA and ultimately vacated the 2022 exam manual update. CBA applauds Chairman Barr for introducing H.R. 6789, which would further clarify the Bureau's authority in this space. Second, facts matter. The Bureau has increasingly misrepresented facts, even its own data, to support its rulemakings. In the run-up to the credit card late fee rulemaking, the Bureau released a steady cadence of data reports describing a card market that's defined by lack of competition and perceived consumer exploitation. But CBA has shown in a series of responses that the Bureau's recent card data report is refuted by the Bureau's own data. More than 4,000 credit card issuers compete fiercely to be top of wallet for Americans every single day. This is one of the most competitive marketplaces you can find. The Bureau similarly released a rulemaking banning non-sufficient fund fees for instantaneous transactions, accompanied by headlines about banks innovating to impose extra fees for no value. Yet the industry doesn't actually charge those fees. The rule was a solution in search of a problem, or more accurately, a solution in search of a headline. Third, American consumers deserve regulators that set aside short-term wins for long-term financial health. Banks have made tremendous progress in banking the nearly 1 in 10 credit-invisible Americans who don't have access to credit cards or other alternatives. From completely fee-free checking accounts to accounts that offer greater flexibility, such as those with overdraft protection, these services are essential to ensure consumers have low-cost options when they need to make ends meet. Yet the Bureau's proposed overdraft rule risks this reducing competition and innovation to a one-size-fits-all government-priced product that will be out of reach for many consumers who need it most. The Bureau's proposed rule on credit card late fees raises the cost of credit for responsible cardholders, but it also risks long-term harm for even the consumers it purports to help. The proposal softens the short-term pain of paying late, but paying late has some long-term impacts on consumers, including bigger bills, more indebtedness, damaged credit scores, and more pain when a consumer goes to finance bigger purchases like a house or a car. Additionally, the lack of consistent approaches to regulating bank small dollar loan products by different administrations have left banks almost unable to offer this product at all. We are very supportive of Congresswoman Kim's draft bill to provide much-needed stability in this space. Finally, it's clear regulators are not considering the cumulative impacts of these proposals on consumers' financial health. Consider free checking accounts. The Bureau's overdraft proposal comes at the same time the Federal Reserve Board proposes to reduce debit interchange by a third. CBA research shows that the board's Reg I proposal would cost consumers free checking accounts, would increase costs for consumers free checking accounts by up to $2 billion a year, primarily for lower and middle income consumers. Banking agencies must stop writing regulations for short-term political wins and instead renew their commitment to policies that are truly for the people. Thank you.
Thank you. Thank you, Ms. Johnson. And now, Mr. Sueiro, you are recognized for 5 minutes.
Good morning, and thank you, Chairman Barr. Thank you to the subcommittee for having me here today. I am Santiago Sueiro, Senior Policy Analyst at Unidos US. We're formerly the National Council of La Raza. We're the largest Hispanic civil rights organization in the US. For more than 50 years, we've advanced opportunities for Latinos, and we've partnered with 300 affiliates from Colorado to Missouri, small towns in Texas and Florida, to big cities on our coasts. Our affiliates are community-based organizations that directly serve Latinos. Working class people, people of color, and Latinos are experiencing mixed results in our current economy. Encouragingly, unemployment is at near historic lows, including for Latino and Black workers, and real wages are rising for working class people as inflation continues to decline. However, too many families are continuing to face significant economic difficulties. Poverty remains higher than pre-pandemic levels, skyrocketing housing costs are burdening a record number of people, and total debts reached an all-time high. Despite gains, wealth inequality remains a concern, with some calculating that fully closing the wealth gap for Latinos could take up to 228 years at the current pace. The past few years in banking have mirrored these mixed developments in our economy. On the one hand, fees and costs have fallen, from overdraft fees to the cost of small dollar loans, and we've made significant progress in lowering the unbanked rate to near historic lows. The fall in overdraft revenue is particularly promising, falling by an estimated 50% since 2019. On the other hand, progress towards inclusion and affordability has been too slow. While some financial institutions eliminated and lowered overdraft fees, others have made very few, if any, changes to their overdraft policies. Many banks are also developing new and promising small dollar loan products, but have yet to put these in the market at scale. Finally, more recent studies suggest that the unbanked rate is trending back up. Backsliding could mean that many will fall into economic hardship or even deeper distress. Congress and financial institutions can make progress towards a more equitable and inclusive financial system by adopting 3 principles. First, policymakers should respect efforts of financial regulators to advance financial inclusion, while supporting innovations in financial services to better meet the needs of working-class consumers. For example, regulators such as the CFPB play a critical role in securing a fair marketplace. Their proposed overdraft rule and recently finalized credit card late fees rule have the potential to save working-class consumers billions of dollars and spare them from unnecessary financial burdens. Financial institutions should continue to innovate in the meantime with products such as the Bank On certified accounts. These are examples of a viable market solution which improves inclusion and equity while complying with safeguards to prevent abusive practices and unfair fees. Second, financial institutions should deeply reimagine the relationship between themselves and consumers to promote customer loyalty and reduce costs. Rather than increasing fees, some financial institutions are offering tools that provide consumers with affordable and flexible credit terms in conjunction with lowering fees. Taking this approach is good for business. It can build trust and loyalty among low-income consumers. If consumers see that their financial institution is willing to be flexible with them, they will in turn be more likely to remain loyal with the financial institution and will use more financial products with that institution as they grow. Third, democratic structures which provide meaningful roles for working-class communities in bank policy decisions can improve outcomes for everyone. Policymakers can make the financial system more equitable by ensuring that lower-income people have a meaningful voice in institutional decision-making. Credit unions, CDFIs, and MDIs are examples of community-owned banks and should be supported and cultivated to reach more people. Regulations that give community members greater influence in bank decision-making processes can also help by requiring banks to meet with community actors to allow lower-income communities to voice their needs directly to decision-makers within financial institutions. Investing in lower-income people by providing affordable, high-quality products will allow banks and communities to grow together. If we create a banking system built on trust and loyalty, one that invests in the long-term potential of working-class people, people of color, and Latinos, we will be able to take one step closer to creating a fair, inclusive, and thriving economy. Thank you, and I look forward to your questions.
Thank you for your testimony to all of you, and now we will turn to member questions. The chair now recognizes himself for 5 minutes for questioning. Ms. Johnson, let me start with you and ask you about UDAP. The CFPB director has used his UDAP authority, not his rulemaking authority, to force lenders to make operational and policy changes. For example, I've heard a growing concern that during the pendency of an examination, the CFPB will release new and/or updated regulatory guidance pertaining to UDAP. The financial institutions are left to chase a moving target, sometimes even resulting in an examiner critique. Ms. Johnson, does this practice allow financial institutions to plan for unforeseen regulatory changes?
No, it does not. And that example that you're giving is, we've seen it as well. We've seen the Bureau and the director himself stand up at a press conference and say something's illegal and actually announce an enforcement. And it's, for banks who have been following the law, who pride themselves on following the law, who that practice or that product was allowed every single day until that point in time, to have an enforcement action come down, to have a headline come out, and to have that enforcement applied retroactively, it's like changing the speed limit. And before you even change the speed limit signs, fining people for every day that they drove this previous speed limit. So very concerning.
I liken it to the Supreme Court justice who said of obscenity, I know it when I see it. Abusive is, for Director Chopra, whatever he sees. And regulated parties don't know what the law actually is. It's a moving target. What can Congress do to prevent the CFPB from abusing its UDAP authority?
I think one of the most important things is to really, your bill, HR 6789, which clarifies the CFPB's authority under UDAP and really ensures that they can't apply something that hasn't been done by rulemaking and apply that retroactively. There are a lot of important instances where UDAP could be applied, but we want to make sure that they're operating within four corners of what Congress is allowing.
I invite my Democratic colleagues to take a look at that bill. We want clarity for banks and credit unions and lenders so that they know what the rules are in advance so that they can comply better with them. If my colleagues want good, clear rules of the road on consumer protection, this fix is much needed. On fees, let me ask Ms. Harbin. Conspicuously missing from the Biden administration's and their proxy, the CFPB's dialogue on junk fees, and we'll hear about it tonight, no doubt, is the fact that the type of fees they're villainizing are charged by government entities every single day. The CFPB itself charges fees for Freedom of Information Act requests. Are those junk fees? The District of Columbia charges fees for parking violations and doubles the amount you owe if you don't pay within 30 days. And if you have 2 or more outstanding parking or photo enforcement tickets, they have a right to put a boot on your car and you must pay a fee to have it removed. Is that a junk fee? The IRS pays 0.5% of unpaid taxes for each month the tax remains unpaid. Are IRS late payments penalties? Are they junk fees? The reason local, state, and federal governments charge these fees is for the same purpose that banks and credit unions charge them, because fees help shape behavior. This isn't rocket science, it's Econ 101. And yet the CFPB discounts the notion that fees serve this critical role as a deterrent and instead seeks to paint financial institutions as tricksters who would do anything to make an extra dollar. This is absurd. Ms. Harbin, would you discuss the necessity of charging fees and how doing so helps my constituents in Central Kentucky?
Yes, thank you, Congressman Barr. Running a financial institution today is very costly, and it comes in many forms. We use AI-powered technology to serve more vulnerable communities. We make loans with those with moderate income, and that's a very costly thing. We also provide free checking accounts, HELOC loans with no closing cost, no late charges or no annual fee on credit cards. So there's lots of services we provide to our members that are very costly that we absorb. We also bear all the fraud, and the merchant bears no fraud when a fraudulent transaction takes place. Their compliance costs are very expensive. In 2023 alone, we spent over $1.3 million on compliance costs, cybersecurity tools, and fraud related to transactions that our members took place.
And Ms. Johnson, really quickly, what will the credit card late fee proposal do in terms of the cost of and access to credit?
That's one of the most important questions that needs to be asked. In terms of the cost of credit, even the CFPB itself acknowledges that 74% of people who pay their bill on time, including 50% of people who are subprime borrowers, will see their costs go up, and those folks are living paycheck to paycheck. For people that are on the margin, that are frequent late payers, they're going to see long-term costs go up. Their credit score is going to be damaged, and it's going to be...
My time has expired, but how obnoxious that the Consumer Financial Protection Bureau will increase the cost of credit for on-time credit card users. With that, the chair will now recognize the ranking member, Dr. Foster, for 5 minutes.
Thank you, Mr. Chair, and our witnesses. One of the areas that we seem to have bipartisan consensus here are the benefits of competition. And one way that I believe we can promote competition and innovation in financial services and across the broader economy is by improving consumer choice and giving them greater flexibility in their decision about which firm to do business with. Open banking and the CFPB's 1033 rulemaking are ways to do just that. While I understand that the details of the proposal, there are details that need to be worked out, I believe it is an important step that will give consumers greater control over their financial data, add privacy protections, and give them the flexibility to walk away and move their business to a firm that better suits their needs. Ms. Johnson, I'm interested in learning more about the technical aspects of the 1033 rulemaking and open banking more broadly. That you note your concern that you believe the technology investments required are underestimated. And so my question is this a situation where firms are dealing with legacy systems that need to be rebuilt in any case to stay competitive? And where do you see the greatest need for investment?
Well, thank you for that question, Congressman. Look, I think that there's a couple of different questions that we've got about this open banking rulemaking in particular, because the market is already driving in this direction, and you see this because consumers actually, Plaid made a comment recently that consumers actually have, as many consumers have fintech apps on their phone as they have streaming apps. And so it is very prevalent that consumers have multiple cards in their wallet. They've got fintech apps. They have multiple different uses of different financial service providers. What we have concerns about is we've got a very limited statute that says a consumer will have access to their own personal financial data, and the Bureau is using that and expanding that authority to say we're going to now change that from a consumer interface technology to a developer interface technology. So from a liability perspective, from a data concern perspective, depository institutions are going to be required to share consumer data to others, to non-depository institutions, fintechs and others. Now that might be okay, but the devil's in the details, and I think that we really have to be focused on how can we do that safely, securely, and not have the liability transferred back to the banks if the fintech or someone else exposes that person's data.
Yeah, so I agree. The idea is good and the details matter a lot. Mr. Sueiro, do you agree that giving consumers greater control over their data and the ability to shift to more open banking would be a net positive for consumers?
Yeah, absolutely. I agree with that. And, the 1033 rule is interesting because not only is it helping to set a structure that will allow for that, there'll be more data sharing, more institutions will be able to access that data and use that. Consumers can, shop around and have more options. But it also allows for strong data privacy protections. Consumers can opt out. There's very clear definitions about what kind of data can be used. And it could lower prices for consumers by way of, lowering costs, competitive prices, fees, things like this.
Thank you. And, open banking is not really a new concept. In fact, Europe and the United Kingdom have already taken impressive steps to advance the concept through the UK's Open Banking Initiative and the EU's PSD2 directive. The UK also has the industry-led current account switch service, which allows consumers to simply open a new bank account and request a switch. And 7 days later, all of your direct deposits, your subscriptions, your recurring payments will all be automatically moved to your new account. And you do not have to spend hours contacting your employer, your credit card company, your streaming services, your magazine providers. The program currently covers 99% of UK checking accounts and is tremendously popular with consumers. Mr. Sueiro, are you familiar with this program, and are you aware of any comparable program in the United States?
I'm not familiar with the program, actually, yeah.
Okay, any of other, Ms. Harbin?
I'm not familiar with that program, but at our credit union, we do offer a Switch It program for members to easily switch their checking accounts from one institution to another.
Yeah, and does that switch just the accounts and balances and so on, or does it switch all of the magazine subscriptions and the telephone bills and everything?
It helps switch everything.
It switch everything, and that is from credit unions to credit unions, but not
Any financial institution.
any financial institution.
I will say that there is some human intervention, but we do have that
And
capability.
obviously the cybersecurity is a big deal when you're moving everything, but I think that is something we should really look forward, just to make the system more competitive and let the consumer get a better deal. Thank you. My time is up, and yield back.
Thank you. The gentleman yields. The gentleman from Florida, Mr. Posey, is now recognized for 5 minutes.
Thank you very much, Mr. Chairman. Mr. Anthony, does the term junk fees have any substantive meaning, or is this just another administrative denigration of, like, shrinkflation?
Sadly, it's not a clear answer. There is not a clear definition of this term. It seems to be what people don't like in the moment. And as my colleague Ryan Bourne pointed out just yesterday, it seems to be changing every day.
Can you explain the impacts of imposing price controls?
Well, fundamentally, you get two reactions from a price control. You get either a shortage when you have the price control set beneath the market equilibrium price, where it's no longer economically viable for businesses to offer that service, and so they cut down the supply, maybe even to zero. Or on the other hand, you have businesses then look to ways they can recoup those costs. So talking about increasing the fees and prices for other services, whether those be niche services that increase a lot or everything that increases a little bit. That's something that businesses will hash out on the spot and something we've seen over time.
Yeah, ultimately, it's like passing a law saying you can't charge over $1 for a gallon of gasoline. End result is nobody gets any gasoline at the end of the day. Ms. Johnson, your testimony describes a pattern of CFPB abusing financial institutions in the press, even when a particular institution might not be the subject of a bureau action. Can you provide a couple of examples of that, please?
Well, the example that we used in our testimony is Lend Up, and in the press release, they actually name individuals who were not even party to the violation. They were investors in the company themselves. But, you know, for others to get past that headline, their names were in 16-point font. So it was a shaming it was really peculiar. Again, they're not members of CBA, but we just find things like that are really ways that the government should not operate.
Yeah, thank you. Ms. Harbin, what are the priority needs for the regulatory reform?
So I think for all financial institutions, we need regulatory reform to make them right-sized regulations and not a one-size-fits-all. I mentioned in my testimony, death by 1,000 cuts. It seems as if that's what we're getting. And all fees are not in a vacuum. And we, as myself as a credit union president, I have to deal with all these fees that come in. They may come in one at a time, but they are very expansive and impact many of our services and many of our programs that we can provide to our members. And even with a exemption that is provided, there's a trickle-down effect where we will be impacted because our members will leave us to go to other institutions that do not charge the fees that are being proposed or charge lower fees, and we will have to lower our fees and adjust them to stay competitive.
Yeah. Do any of the witnesses think that it's a reasonable principle that people who don't bounce checks should pay for people who do? Does that sound?
So the program, we need to look at the program in its entirety and not just one aspect of it. We see that the more people that overdraft their accounts are intentional. They want overdraft protection, and they want us to provide it, and have even threatened if it's taken away, they will leave us and go down the road to another less desirable option, such as a payday lender.
Thank you all. Thank the witnesses. Mr. Chairman, I yield back.
Gentleman yields. The gentleman from California, Mr. Sherman, is recognized.
Thank God for the CFPB. They returned $17.5 billion back to Americans in the form of monetary compensation, principal reductions, et cetera. But that's the tip of the iceberg. They have discouraged a whole variety of bad practices that otherwise would have cost Americans, I'm sure, tens and tens of billions of dollars. We're told that more people are unbanked. I want everybody to be banked or credit unioned, but the modern system we have for the unbanked is so different from when I was growing up. When I was growing up, if you were unbanked, you took your paycheck to the liquor store and paid a huge fee and got cash. Hope you weren't robbed on the way out of the liquor store, and then paid your rent in cash. Clearly, today's unbanked on Venmo, on PayPal, or whatever, are better off with today's technology. It's not as big a problem. In looking at the credit card system, again, when these fees were designed, you had a carbonized slip with bumps on the card. You created carbonized slips, huge costs to deal with all the paper. Somebody had to like get that, try to read it. It's a third carbon, typing it in. Today, all that backroom stuff is done much cheaper, but also today, but back in the old days, you want to use your credit card, you whipped out your driver's license, and a clerk made sure, hey, I use my wife's credit card. I don't really look like her, thank God, and nobody's ever questioned it. We're told about junk fees. There is no exact legal definition, but a junk fee is a fee you're not aware of and don't expect until you're pretty much done with the transaction. When you're at the airport and you learn that you're going to have to pay to have even one bag on the plane, that's a junk fee. In contrast, I think if you park in a no parking zone or you don't pay the IRS on time, you expect a fee. But I don't expect an add-on to my cost when I go to the airport. I think one of the quotes that was used here was that people will go back to loan sharks. I haven't seen Tony Soprano in my district. I don't know if that's a real risk that we have to worry about. I want to focus on identity theft. In 2023, there were more than 1 million reports of identity theft. Financial services realm, it's become more relevant. Financial institutions have to have verification systems in place. Ms. Johnson, how would you characterize the challenges your members face in detecting and combating identity theft? And is there something Congress should do? And I'll point out one thing Congress should do, and that is when the retailer holds the data and is negligent, they should pay for that negligence. Over 100 years ago, we developed the tort law theory that you impose the costs on the entity that should have been more careful. But of course, when credit card data is lost by a merchant, your members pay the cost even though they weren't negligent at all. In any case, what do we do on identity theft?
So it's an enormous issue right now, and not just with identity theft, but honestly with all fraud and scams. And this is one of those issues where I think it should be bipartisan. I think that we all recognize, when I talk to some of my largest members from the very biggest banks, and I guarantee you Ms. Harbin would agree, I've heard multiple times that fraud was the #1 driver of losses at many institutions. So they are continuing to really try and protect against all kinds of fraud. It's old school fraud, like check fraud, and it's very new, innovative ways where people are just getting scammed by text messages, by other things. So my recommendation would be, let's pull all the relevant parties together. It's the telecom industry. It's the CFPB who can help educate consumers. Congress has a role here.
And I'll also comment that the Fed needs payee matching so that when you wire your money to an account, it's to a particular entity and not a situation where some scammer can convince you to send your down payment. You think it's to the escrow company and it's going to a Nigerian prince. I yield back.
Gentleman yields. The gentleman from Missouri, Mr. Luchtenmeyer, is now recognized.
Thank you, Mr. Chairman. I know many of our members have been talking about junk fees. Let's define junk fees, what it really is and where it really came from. This came from Director Chopra. He doesn't have authority over certain things. So he makes up this word, junk fees, and throws everything in this pile to now have coverage for himself to go out here and use UDAP to be able to go investigate these things. This word is made up. It doesn't have any basis in the financial services lexicon, and it's not legally enforceable. It is a made-up word, and now has become a talking point for the other side. This is nonsense. This is how far the CFPB has gone to extend their own authority over things they have no authority to do. And while we're talking about politicization and financial regulation, this is the paramount example of that. My good friend from California talked about the $17 billion that the CFPB has recovered. I would call it extortion money, because if you look at where most of it came from, it's extorted from the people that made the payments, which is not the way that this government should operate. That being said, lots of stuff to talk about today. The CFPB has proposed to replace a credit card late payment fees rule that was created by the Obama administration with a new approach that will radically reduce the incentive for consumers to pay on time. In fact, the CFPB admits that more consumers will pay late, leading to more late payment fees being charged. The CFPB states in the proposed late payment rule, I'm going to quote, "In developing this proposal, the Bureau recognizes that late fees are a cost to consumers of paying late, and a lower fee amount for the purpose or for the first or subsequent late payments might cause more consumers to pay late." Ms. Harbin, what do you think about that?
So in this challenging time that we all live in, life happens, and there will be people that pay late fees, no doubt. Our fees, and our credit union and all credit unions, as well as all financial institutions, are highly disclosed, regulated, transparent, and a member knows what they are doing, just like with the overdrafts. We have members request overdrafts, and we see in their transaction history that they will move to another institution to get their overdrafts or to a payday lender or less desirable option. We have members that come in and talk about how pleased they are, how thankful they are to have overdraft. And a recent story that came from a team member is a young mother came in and had to choose between feeding her kids and paying the light bill. And when we reminded her of the overdraft that was available to her, you could see her light up. And she said, "I don't have to make that choice."
Yeah,
So
I can tell you from being in the business, people appreciate the fact you don't return their check. They pay for that service. It's like any other service that you provide. They don't want that check returned because it's a negative on their credit. They would gladly pay an overdraft fee to be able to protect themselves and their credit. It's very, very, very common. Ms. Johnson, thank you for mentioning my Secure Payments Act. I'm worried about the Federal Reserve's shoddy proposed Regulation II rulemaking and its impact on smaller financial institutions. As you're aware, when the debit interchange cap was originally implemented, it led to a reduction in debit interchange at institutions that were under $10 billion in assets and therefore exempt from the cap. These small institutions already struggle to break even on debit product offerings and are the least able to absorb losses in debit interchange revenue. How will the proposed rulemaking impact smaller financial institutions?
Well, thank you for the question. And, CBA represents primarily institutions over $10 billion in assets. So we, are going to be directly exposed to this rulemaking. And we've got 10 years worth of data now to go back and say, we know what happens. Last time the Federal Reserve reduced debit interchange by 40%, and consumers saw their free checking account access costs go up by about 30%.
This is study after, by the way, this is study after study that shows this happening, is it not?
Absolutely. By the Fed, by the GAO, by academics, and smaller institutions also felt that impact. It was a direct impact on their ability to offer free checking accounts as well, because they saw revenue decline about 30% as well. So we can carve out small institutions, and I know it might be politically savvy to do that, but people still feel it, as well as.
Well, there's this kind of wink and nod with the regulators. They kind of wink and nod and say, this is a good idea to comply with this because sooner or later it may come to where you have to. So that's kind of the way they operate. Mr. Chairman, I'll yield back the rest of my time.
Gentleman yields. The gentleman from Georgia, Mr. Scott, is recognized.
Thank you, Chairman. Mr. Sueiro, how are you?
I'm good.
I want you to know, first of all, I strongly support the Community Reinvestment Act, and this is why. I believe it's been very instrumental in ensuring that low and moderate income communities have good access to the credit they need and the financial services that they need. However, the CRA must adapt to this changing world we're faced with now. It looks very different than when we first enacted this law. The growth in financial technology, the price of purchasing a home or opening a business, all demand a more robust CRA for 2024 and into the future. And this is why I believe that federal regulators, their proposal to automatically make housing credits and community development financial institutions support fully the CRA eligible, and that is the correct approach. The CDFIs in particularly are very vital for increasing the availability of capital, of credit, financial services to our low-income communities all across this nation. So, my question to you, Mr. Sueiro, is this: why was it important for regulators to make equity investments and loans CRA eligible, as well as fully crediting investments in CDFIs? Could you help us with that?
Yeah, so first, to understand this, we have to understand that there are a lot of low-income communities, disproportionately communities with high concentrations of color, that are lacking access to investments, lack access to loans, bank products, and things like this. The CRA, the whole purpose was to incentivize and provide reasons for financial institutions to serve those communities. CDFIs in particular, just as you said, they're required to serve underserved communities, low-income communities. So having them included is a big deal for them because they're already serving those communities. What they lack is capital. Every time we talk to them, they all say, we want to serve more people without access to loans and investments, but we need the capital. The CDFI fund helps with that, but also investments from financial institutions can help with that. So having that included in the CRA rule, having that be an incentive for financial institutions to work with CDFIs is a really big deal. It can have a big impact.
Well, I'm very glad you brought up the importance of access to capital. That is the key. CDFIs rely on the CRA to secure capital from private financial institutions. With CDFI program award recipients raising on average 21% of their capital from financial institutions. And this is according to the 2023 CDFI report that was their fund, and this was their data. So my point is that without the CRA and the CDFI industry today, we would be just a fraction of its current size and the scale of its lending and investing and impact on is significantly reduced. And I just believe that the proposal does meet the needs of our objective audience. It will ensure that banks are both obligated and incentivized to deepen their investments in the communities they serve. And Mr. Chairman, I'm so delighted that we're having this hearing. It's very important. It's very timely. Thank you.
Thank you, Mr. Scott. The gentleman from Texas, Mr. Williams, is now recognized.
Thank you, Mr. Chairman. And
Small businessman.
Small business owner from Texas. I'm a car dealer in full disclosure back in Texas. And I'm glad to be a part of the fight to stand with you on this. And as part of the CFPB and Biden administration's misguided crusade on junk fees, which I thought we got rid of back with Obama, the CFPB has proposed a rule that restricts consumer overdraft services offered by the banks, which we've talked about today. And this proposal is an attempt to regulate overdraft as credit, which would require additional disclosure and underwriting, ultimately leading to many customers being priced out and eliminating a lot of loans that you might make to small business owners for payrolls and other things. Now, overdraft services offer a variety of benefits to increase financial flexibility and emergency access to funds. many consumers will lose this critical safety net and be forced to turn to less regulated alternatives. We talked about that. And it's funny, on the other side, they're going to always help everybody, but the people they hurt are the people they think they're helping. So, Ms. Johnson, could you elaborate on the negative effects consumers will face because of this proposal and the burdens it will place on financial institutions?
Yes, thank you for the question. Consumers do opt into this product. 80% of consumers who use it say that they are really so grateful to have it, to have availability to it. Large lenders in particular have made significant innovations, not over the last couple of years under Director Chopra, but over the last decade, to the tune of about $28 billion for a 4-year period from 2021 to 2025. That's what we anticipate consumers are going to save. These innovations include 24-hour grace periods, include de minimis amounts as high as $100. So many consumers still see the bank standing the gap for them to cover the transaction, and they don't ever experience a fee. So it's a great program. It's a great product for consumers to have. We couldn't see this being made a credit product fitting under Reg Z, because it is a very, very different product. You would have to not only have a disclosure to that consumer every time the consumer overdrafts on their account, but you also have to underwrite those consumers. And many of these consumers it's an emergency expense. They can't plan for these types of things. Many of the consumers that use overdraft also are almost credit invisible. They have very thin credit files, and so to underwrite them would also be very difficult, and they would probably lose access to it.
Well, it's called being customer friendly. It's also called giving service, which is what that is. Mr. Anthony, I want to talk about another proposed rule coming out of the CFPB that will end up harming customers. The proposed rule aims to limit the amount that companies can charge as late fees for credit card and missed payments. And currently, there's a safe harbor maximum of $30 for the first violation, $41 for the subsequent violation within the next 6 billing cycles. The CFPB has failed to realize that reducing this safe harbor to $8 will have a negative consequence, and increased costs will ultimately be passed down to who? The consumer. So the rule will erase all options for making payments on time, facilitate more late payments, increase the overall cost of credit. When the safe harbor fee is lowered, you are punishing those who pay on time and will end up lowering access to credit. So, Mr. Anthony, can you expand on the consequences of government-imposed price controls and how consumers will absorb the cost and pay more credit?
Well, thank you for the question. Fundamentally, at the broadest level, it's a knowledge problem. It's assuming that we can figure out what's going to apply for every single bank, large and small, every single credit union and the like, and then force it down to be some binding price control that ultimately results in either shortages where people are completely denied access or higher fees elsewhere, which seems to be just kicking the can down the road and creating more distortions in the market.
Well, government-imposed price controls, that sounds a little like socialism, doesn't it? So the time I got remaining, Ms. Harbin, let me just ask you this. With all the politicized regulations coming from the Biden administration, could you elaborate on how the regulations we have discussed today would affect your credit union's lending ability, and how would it affect your ability to lend to a small business like mine that employs several hundred people?
Thank you for that question. So it would drastically impede our ability to lend to small businesses, as well as increase our compliance cost. We spend a lot of money on cybersecurity and prevention of fraud for our members. That is costly, and because of those costs and the fees go down, we would have to eliminate some services or start charging for services that we don't charge for now.
Well, that's great, and I appreciate you all being here. We're going to keep fighting, and I yield my time back, Mr. Chairman.
The gentleman yields. The gentleman from California, Mr. Vargas, is recognized.
Thank you very much, Mr. Chairman. I want to thank the witnesses here today. Appreciate very much your work. You know, my good friend on the other side just mentioned socialist and was mentioned a little bit earlier. I'm tempted to ask, but I won't, and not to embarrass anybody here, if credit unions are for-profit institutions. Because I've been a member for 45 years of a credit union, and a credit union doesn't make a profit. Whatever it makes, it puts back into its members. And in fact, you know, someone could say that that's socialism. You know, but it's not. I don't think it is. I'm not a socialist, but I'm a credit union member for 45 years and very proudly. And in fact, we heard the history today of what credit unions do in a particular area in Kentucky. I can tell you, Mr. Chair, that same thing happens in San Diego. We have wonderful credit unions. They're not for-profit institutions. They're not socialists. I don't think. I mean, I've never asked them. I don't think they've been accused of being a socialist, but they're not for profit. I mean, it's very interesting. Now, they do compete with banks, and banks often do call them socialists. So, to be fair, I just did want to mention that. Now, I've been around here long enough that when I first got here, it was Dodd-Frank that was the boogeyman. It was disparaged, it was criticized, a whole bunch of things. Now it's quoted. Now it's quoted by the other side by saying, well, wait a minute, we don't need new regulations, capitalization standards. We don't need that. We have Dodd-Frank. And in fact, when we had the CEOs from the large banks here, when they were asked, what do you think of Dodd-Frank? They said, well, actually, it helped. It helped during the pandemic, a real stress test. I mean, back in 2008, when we had that disaster, there wasn't anything in nature that happened that was bad. It was bad policies. We had the pandemic. The pandemic, that's something that is real. I mean, that was something that nature did. And we think it might have been somebody else. It might have been the Chinese. I don't know who did it, but something happened there. Certainly was global and significant. That was a stress test. And the financial system weathered it very well. Again, thanks to the changes that were made. Now, that leads me to this CFPB. Of course, today it is being demonized and, again, being disparaged and criticized. And I have to tell you, back home, I get an enormous amount of praise for the CFPB. They've helped a whole bunch of people in my district. I mean, I get praise for them all the time. It's one of the federal institutions they seem to really like. So I don't know what the deal is here. I mean, we could argue about whether it's $20 billion that they've gotten back to consumers or it's 17. My good friend from Sherman Oaks, the best named city in America, Mr. Sherman from Sherman Oaks, as he likes to say. But the truth is they've done a great job. They've also helped a lot of veterans. I mean, a lot of veterans in my district, I represent Santiago, praise the CFPB for all the things that they've done. Now, all that being said, we talk about junk fees, and you can call them inappropriate fees. You can call them, disproportionate charges, opaque fees. You can call it anything you want. You can call them diddly. It doesn't matter. There are fees that Americans don't think are appropriate. And that's what I think the CFPB is going after. Now, I do have some concern, and I'll be frank again. The CFPB is not always right, and I do have some concern over credit unions. Because, again, I think that credit unions, may get hurt unnecessarily here. I really trust credit unions. I would like to hear from you. I don't want to mispronounce your name, but Cato. I don't want to call you by your first name, but Cato, you know who you are. Go ahead.
So credit unions, by their very nature, are not-for-profit. We're for service, for people helping people, and we give back to our communities every day, just like Chairman Barr talked about. We're a volunteer organization. Our board members serve voluntarily, and they're elected.
But could you talk about the fees, just the fees? Because I agree with you. I mean, I would praise you too. I mean, you guys are great. But about the fees, how they might hurt you.
Okay, fees are not in a vacuum, and the fees that are currently being proposed or have been implemented are hurting our credit union in order to serve the less vulnerable people in our communities.
Are they disproportionate, or do you think your fees are disproportionate?
I think they are. I do.
I think you might have misunderstood my question, because my question, are the fees that you charge disproportionate? You said yes. I think you meant to say
no. I did misunderstand your question.
Okay.
They are not, because when you charge fees, you're not just paying for the cost of that program or that overdraft. You're paying for everything. Okay. You're paying for the cybersecurity that supports transactions. You're paying for the fraud that we bear. The merchant bears no cost, yet they want members to use the card. It is 3 times more expensive to use cash than it is the interchange that merchants earn.
Thank you. Thank you.
Welcome.
The gentleman's time has expired. The gentleman from Georgia, Mr. Loudermilk, is recognized.
Well, thank you, Mr. Chairman. Thank you all for being here. Very important topic that we're discussing. It's incredible that we're seeing such a drastic change, such drastic changes being proposed by something that has been developed over years to protect both consumers as well as the financial institutions. And I thank you all for coming to testify on the politicization of our financial regulators. This evening, the President will appear before the House and the Senate and declare that his administration has kept its promise and cracked down on the so-called junk fees, which I don't think are actually even clearly defined. The administration has described this crackdown as a war on fees, but it's more accurately a war on the American consumer. This is particularly clear with the CFPB's proposal on overdraft and late fees, which hamper consumer access to the bank products that they depend on. Ms. Harbin, if a member of your credit union repeatedly used your overdraft product and paid the fee multiple times in the same year, do you think the member, A, doesn't understand the product or its associated fee, or B, is choosing to use the product as intended?
Thank you for that question. I believe they are intending to use the product as it is intended. We track whether it's a first-time user, whether it's an excessive user. We have so many controls in place that help our members understand the program. When they open the account, it is thoroughly explained what our overdraft program consists of. They then receive a letter in the mail that reiterates how the program works. The first time they use the program, they get another letter to educate them. They get an excessive use letter. And then we spend lots of time counseling members on the phone, explaining that if they need money to get them from paycheck to paycheck, why not take one withdrawal from the in cash, pay one fee instead of multiple fees that might come in when they write a check or facilitate a transaction.
Interesting. So it sounds like to them, this fee, this service is a benefit to them.
Yes, sir, it is. And we feel it is our responsibility to educate our members and not dictate how they manage their finances. And that's very important because, as I think I previously said, members want the service. They request the service. They will go elsewhere to get the service if we don't provide it. And we can see that in transaction history. If we take a member out of overdraft protection, we can see where they go to a payday lender.
So can you give us any examples of specifically how your customers utilize this service?
So normally, and in most cases probably, it is just an accidental. They don't realize that they don't have the money in their account, and we empower our staff to give back 2 fees without any other approval. And anything over that, it usually comes to a management level to approve the fees. But we refund, last year, we refunded about $600,000 in fees to our members. So we listen to them, we talk to them, we counsel them, and we're here to make their lives better.
So how do you think the Bureau perceives these consumers? Do they perceive them as rational consumers?
I think the Bureau misunderstands why consumers want to use the service, and they think that they don't understand what they're doing, when in fact, they do understand and want and request the service.
Yeah, is it fair that the Bureau presumes that the consumers don't understand the product they use?
It's not fair that the Bureau believes that.
Right.
Yeah.
And how do you perceive that your customers would respond if you educated them on what the Bureau is trying to do?
They would be very unhappy. Like I said, they want the service.
What alternatives would some of these have? If these were taken away, what are the alternatives that they would have for shortcomings?
They would go to a payday lender or some less desirable option that we cannot no longer provide.
But payday lenders are going to be more expensive, more damaging. Okay.
Yes, and that's not something that we want. It's not something Congress wants, and it should not be something the Bureau wants.
Well, the Bureau's not even sure what they want other than just junk fees are bad, and we're just going to get rid of them, regardless if they help the consumer with that. Mr. Chair, I yield back.
The gentleman yields back. The gentlewoman from California, the ranking member of the committee, Ms. Waters, is recognized.
Thank you, Mr. Barr. Ms. Sueiro, for many years I've led the effort in Congress to both strengthen the Community Reinvestment Act and guard against extremist attacks seeking to undermine it. Following the 2008 financial crisis, I pushed back against Republicans who had the gall to suggest it was CRA, not predatory lenders or greedy Wall Street bankers that caused the crisis. Years later, when Joseph Otting, the former comptroller of the currency, who was appointed by Trump, proposed a rule to unilaterally cut and gut the CRA, I led the charge to block this shameful effort. I convened committee hearings, sent letters, advanced legislation, and even led a delegation of committee Democrats to attend a public FDIC board meeting to protest Otting's extremist effort. So I was pleased that last year, the FDIC, the Fed, and the OCC worked together to jointly finalize rules strengthening the implementation of CRA. This was critical because we continue to see modern-day redlining throughout the country, yet roughly 95% of banks still get satisfactory CRA grades. Well, in your view, do these new rules move the needle in the right direction so we can put an end to redlining?
Yes, so Congresswoman, I can say that what the regulators did is to install a system that has a higher threshold and provides stronger incentives to provide loans in lower income communities. So what they found is that with the new model, it's a formula that they've used. They're using a benchmark, an industry benchmark, so it's basically like grading on a curve to compare across how different institutions are doing. And they found that this would provide much stronger incentives for financial institutions to provide loans in low-income communities. It also provides a lot of incentives for not just loans, but investments, different types of investments in housing, affordable housing, investments in community centers, health clinics, all types of even green space. So the new proposal and the new form could potentially have a really great impact on lending and investment.
Thank you very much. Let's move to junk fees. You previously testified before this committee on the hazards of overdraft fees. You mentioned that Latinos and other communities are overrepresented in low-wage jobs with fluctuating hours and income volatility, which means these families are more likely to incur overdraft fees. This seems like a classic example of how it is expensive to be poor. When I was chair of this committee, we advanced legislation to curb excessive overdraft fees. I also convened oversight hearings with our megabank CEOs, allowing our members to ask about these policies. And since then, a number of banks have voluntarily made changes to their overdraft fee policies, either reducing those fees or eliminating them altogether. Do you think this has been helpful for consumers, especially those who are considering opening a bank account?
Absolutely, and so it's worth mentioning two things here. One is when we're looking at the lower income consumers, the underlying issues are lack of access, lack of income, so low incomes, fluctuating incomes, volatile incomes, and high expenses. So a lot of times with that specific population, the reasons that they're overdrafting have a lot to do with they're having trouble making ends meet at the end of the month. And the second part of this is they might not have access to a cheap or affordable line of credit, right? So they find themselves in the pinch. They have to decide between, do I pay my rent or do I overdraft? Of course, people are going to overdraft in that situation. And so it's a little bit counterproductive for them in that situation. If you're piling on $35 overdraft fees multiple times a day, you're digging them into a deeper hole. So it's good for business, it's good for the consumers and good for business if you're saying, hey, let's lower this, let's give you a chance to get you through this and pay it back in a way where you're not paying too much money back and you can actually afford to pay it back, and then we'll keep your account, we'll keep your business, and we'll work together moving forward.
So you mentioned in your testimony in 2022 that excessive fees should be limited through regulatory approaches. Of course, the CFPB has been very active under the leadership of Director Chopra to combat junk fees. Can you discuss how their efforts to curb overdraft fees, credit card late fees, and other fees will really help consumers?
Yeah, well, it'll save money on the one hand, and it also, in some ways, help inclusion. One of the top reasons that unbanked people give for not having a bank account is high costs, high minimum balance requirements, and high fees of all kinds.
The gentlewoman's time has expired. The gentleman from...
Thank you very much.
The gentleman from Tennessee, Mr. Rose, is recognized.
Thank you, Chairman Barr, and thank you to our witnesses for taking time to be with us here today and for preparing for this hearing. Ms. Harbin, I understand that your credit union is not a community development financial institution, or CDFI. However, I know that 1/3 of all community development financial institutions are, in fact, credit unions. So I assume that you are familiar with the industry. Can you share what you have heard from your colleagues in the credit union and banking industry about their experience regarding the complexity for the latest application process for CDFI certification?
Thank you for that question. In fact, we have looked at being a CDFI credit union, but frankly did not have the resources to devote to that. And the process is very lengthy, very cumbersome, and lacks clarity. And I have heard that from many of my colleagues as I represent America's credit unions.
And if you could expand a bit on what you've heard about the lack of clarity from the CDFI fund process.
So that we need more transparency, that greater congressional oversight of the fund and improvements in the program. And we do support the CDFI Fund Transparency Act and Rural Credit Access Act.
Well, thank you. I appreciate that. And in fact, the impetus for that legislation is really this lack of clarity. What I had been hearing from credit unions and others who are CDFIs is that the lack of clarity, the unresponsiveness of the CDFI fund and the CDFI fund director is what led to the introduction of H.R. 3161, the CDFI Fund Transparency Act, along with my colleague on the other side of the aisle, Representative Pedersen. And this bill would require the CDFI fund director to testify in front of Congress annually, allowing our committee to utilize its oversight authority to ensure the fund is functioning as expected. And frankly, our attempts to get clarity from the CDFI fund program and its administrators is what led to this legislation. And I know that consternation and confusion has been true on the other side of the aisle as well. Do you think that bill would solve the problem?
I certainly think it would help solve the problem.
Thank you. Shifting topics, I would like to touch on the current rulemaking of the CFPB that would cap credit card late fees at $8. I'm concerned that this rule could actually incentivize individuals to make late payments on their credit cards and have the unintended consequence, you might say, of in turn lowering their credit scores. Ms. Johnson, do you agree that such a credit card fee could actually end up incentivizing individuals to make late payments?
I do. I do have real concerns about people. Actually, one of the things that's most important to recognize about credit cards is they are one of the #1 ways for people to get access into the banking system, to build their credit, and to have better financial health long term. If you miss a single late payment, you might be saving $23 under this final rule, but long term, missing a single payment, it could drop your credit score by 100 points. That has much bigger costs associated with it in terms of trying to finance a car, trying to finance a home. So I've got real concerns.
So it appears to me that the CFPB is doing the opposite of consumer protection and maybe creating consumer harm. If a consumer makes a late payment on a credit card, and I think to some extent we've all been there will be significant harm to their credit scores. And I'm wondering, Ms. Johnson, could that not also end up resulting in higher interest rates, fewer loan options, and even fewer housing options for many consumers?
Oh, it absolutely could, yes.
Okay, thank you. Mr. Anthony, I have been a huge advocate of Bank Secrecy Act reform during my time in Congress. To that extent, I have introduced the Bank Privacy Reform Act that my colleagues Mr. Sessions and Mr. Ogles have been so kind to join me on. Mr. Anthony, I know that you also share concerns regarding the lack of privacy protections in the Bank Secrecy Act. In addition to increasing privacy protections for consumers, would you please detail how reforming the Bank Secrecy Act would also make products and services more affordable? And you got about 10 seconds.
Well, thank you for the question. Quickly, banks and financial institutions in the United States spent an estimated $46 billion in 2022 in compliance with this. And it's something that comes down to all consumers, not just violating their privacy, but also costing them more at banks.
Thank you, and I'd welcome you expanding on that for the record, if you will. Thank you, and I yield back, Mr. Chairman.
Gentleman yields. The gentleman from Illinois, Mr. Caston, is recognized.
Thank you, Mr. Chairman. I'm just sitting here chuckling at the last comment that if lowering late fees encourages people to commit fraud, then I hope we can all in this committee on a bipartisan basis thank the judge in New York for giving Trump a $450 fine. The sooner he pays, the sooner we can encourage him not to commit further financial fraud. Hear, hear, in the name of fines and penalties. I say that to start because we're talking about an agency that is tragically partisan. The Trump-appointed head of the CFPB famously sat where you all are sitting a few years ago and refused to acknowledge that the primary goal of the Consumer Financial Protection Board was consumer financial protection. We tried and we tried, and we could not get her to say that that was actually the primary goal of the agency. Consumer financial protection should not be partisan for the Consumer Financial Protection Board, but it's become that way. And we need to keep making sure that that agency does what it's designed to do. We've got a bill that's been noticed today from the chairman that would block the CFPB's ability to combat discriminatory practices from unfair, deceptive, or abusive acts or practices, in spite of the fact that the CFPB has been found to have provided over $13 million to 27,000 consumers in Kentucky. On behalf of the people of Kentucky, thank you for the CFPB, for protecting financial consumers. In that vein, I think this conversation about whether it's good or bad to lower the late fees at the CFPB, I think misses the point. I also spent most of my time in the private sector. And I'd like to remind people that the way you price things is not by minimizing the cost, it's by charging as much as you can. If you all want to buy widgets and I'm a widget salesman, it's $1,000. And if you say that's too high, I'll offer you $9.99. We'll see. We'll have the negotiation and we'll see where we're set. But we know that, we found that 18 of the top 20 issuers set their fees near the top $40 range right now. And if we lower it, it's going to lower that charge. I want to start with you, Mr. Sueiro. How will that lowering to $8 have a tangible effect on folks who are living paycheck to paycheck, low, moderate income folks? Where do you see the primary benefit of this reduction coming?
Well, it's similar to what I just mentioned about overdraft. A lot of the people who are paying a late fee are disproportionately lower income, are disproportionately people of color. And the reasons why they're late is they're in the similar situation. They're trying to decide, can I make this payment on my credit card, or do I pay for necessities, basic necessities like paying my rent, paying for food, paying for child expenses. And so it's helping them to. They're already in a difficult situation, but lowering the fees is going to keep them out of an even worse situation. And it's not a deterrent in that situation to raise the fee because it's an impossible situation. You can't decide, no matter how high you put the late fee, it's not going to keep you from having to pay for your rent or for urgent expense. So it'll save a lot of money.
How about for seniors? I saw some data recently from the Federal Reserve Board that said almost half of Americans over 60 are likely unable to even make a partial payment on their cards for folks on fixed income. Have you done any analysis of what impact this would have on seniors?
I'm not as familiar with that report.
Okay.
Yeah.
Okay. Shifting to either Ms. Johnson or Ms. Harbin, the current fees that you all are charging, would you say that those are primarily to cover your costs of dealing with higher fees or punitive to discourage high fees in the first place? How do you balance that when you think about the pricing?
So a couple of things. One, just on the fees that consumers pay, if you look at credit cards overall, the people who pay the most in the credit card system are high-income individuals. So things like annual fees are primarily paid by high-income individuals.
Well, I just want to stay on the question because I want to get to another point, and I don't want to be rude, but I've got to watch this clock here. I'm just wondering, whatever your fee is, do you think of that as a fee to discourage behavior or a fee to recover your costs associated with having to underwrite the behavior?
All of the above.
Okay, and I ask that because what I'd love to know is, you all have a whole variety of tools that you can use to discourage people from paying late. Can you give any color on other tools you have used besides fees that might reduce the cost structure?
And actually, the number of people who are paying late has gone down, and we want to continue that trend. And so banks are really encouraging and incentivizing consumers to not even just pay a partial amount of their total bill, but the full amount. They're giving payment reminders. They're doing automatic payment. There's a lot that we can do with technology now to really help inform the consumer and give them complete control so that they can make those payments, hopefully at a time that's convenient and that they've got the money to do it.
Yeah, no, I'm glad you, because I think CFPB has reported that as well, that some of the more proactive measures that we can do cut the cost, and then we're not having the zero-sum conversation around, let's lower your costs so that there's fewer costs to pass on. Mr. Sueiro, did you have something you wanted to say in the last 7 seconds?
There's other tools as well. These days, credit card companies can tell you more frequently what your credit score is. And so you have more frequent information about that. If you miss a payment, they'll tell you, and that can act as a deterrent. Credit card companies can also change the credit limit as well. So there's a number of different ways in which credit card companies can provide other deterrents that aren't just a late fee.
Thank you. I'm hearing the polite gavel there.
Expired. The gentleman from Wisconsin, Mr. Fitzgerald, is recognized.
Thank you, Mr. Chair. Interesting hearing this morning. I don't know if you've seen it. There's a video on Instagram right now of a gentleman working at Jimmy John's, and the customer wants to pay with cash. And he says, I can't take cash because our system is down. And I think we all are becoming more familiar with what the system is. It's kind of this arbitrary thing that's out there that's been handling our own personal finances now for years, and an exceedingly quick rate that is beginning to change. And nobody wants to pay for the system now. They want it to just exist. They want to be able to do all their personal finances off their phone, but they don't want anybody to pay for it. So I think the discussion about the fees, because they're all kind of lumped into the phrase junk fee, as we've heard many times today, has become, I think, somewhat abstract and no one really understands it, right? So as we continue to press for more accessibility for the consumer into our financial institutions, I think we, as members of Congress, have to figure that out. I don't think that Director Chopra really has kind of grasped it could have the opposite effect. Everything that's been done, I think, is hampering our ability to deliver for consumers. And I don't want to move to a cashless society, but it does feel like that's kind of where we're headed sometimes. Ms. Johnson, can you talk about how your broader customer base will face kind of higher costs and reduced access if credit unions and banks are effectively prohibited altogether from paying for the system which we're insisting on exists, and we all know there's additional security risks related to all of this?
That's a great question. I know probably one of the most prime examples right now is Regulation II, because again, we've got 10 years worth of data now. We can see exactly what happened. And when we reduced those fees by 40%, over 10 years ago, we saw access to free checking accounts reduce and cost to consumers increase by about 30%. We've taken that and now applied it to what the Federal Reserve is proposing to do now, which is reduce revenue again, interchange revenue again by 30%. And we expect that that's going to raise costs to consumers by up to $2 billion. So it has a direct correlated cost, and these costs offset many things. It goes to cover the cost of credit. It goes to cover the cost of fraud. It goes to cover the cost of bringing more people into the financial system. Again, once that revenue for everybody was decreased, The free checking account access was also decreased, and those low and middle income borrowers, about 70% of the burden of that cost was borne by those individuals. So it is directly correlated.
Yeah, Ms. Harbin, I mean, when you have to address the needs of your customer base within the credit union, I mean, I don't think anybody's walking in the front door and saying, I want less access to my own personal accounts. They want more. And when you talk to your IT department, I'm sure the concerns are there are many different things that have to be covered to make sure that this is a secure system. Is that not accurate?
Yes, that is exactly accurate. The cost to protect the security of our credit union and our credit union members for safety and soundness is skyrocketed. We see in the news ransomware and all kinds of attacks, and the cost of those systems is very, very expensive.
Yeah, I mean, I would say, Mr. Chairman, I mean, we all have this list of passwords somewhere, either in your head, hopefully, and not written down somewhere. But the other thing I would just say is that when it comes to the CFPB, I often think there's a disconnect between what their goal is and what's actually happening on the street. And I think that this hearing this morning has definitely underscored that. So I yield back.
Thank you. Gentleman yields. The gentleman from South Carolina, Mr. Timmons, is recognized.
Thank you, Mr. Chairman, and thank you to the witnesses for being here today. Ms. Johnson, I'm going to start with you. This administration's so-called war on fees may sound like a catchy political headline. However, when we look at the totality of the rules coming out of the CFPB and other regulatory agencies, the end result will be a reduction of bank revenue. Fees help offset operational costs for the bank and can help reduce costs for products and services offered by a bank. Would you help us understand how reducing bank fees may ultimately harm consumers, particularly those with limited financial access or who may not have pristine credit scores?
Yes, absolutely. So again, fees are used to cover a number of different things. But one of those things, for example, with the credit card late fee rule, where you've got 74% of people who pay on time and 50% of those people are subprime borrowers who live in paycheck to paycheck, but they are saving, they're paying their bills, and we know that their costs are going to go up. It's going to just make it harder for them to pay those bills. But being in the credit card system, being in the banking system, when this well-regulated system allows them to build their credit and get cheaper financing longer term, so it's going to hurt them. The 26% of people who are frequent late payers, again, may save $23 short term on that late fee payment, but the costs of paying late are significant. Your credit score is going to be damaged, and then the cost to go out and finance a home or a car becomes much more extraordinary.
I want to expand on that. So this war on fees purports to reduce fees charged to consumers by several industries, including, but not limited to hotel and lodging, transportation, groceries, and entertainment. For example, the CFPB argues credit card late fees are junk fees. Would you explain how credit card late fees are different from junk fees?
Sure. So the administration, or the CFPB in particular, has used two arguments, kind of to your point, about why they're going after junk fees, whether it's overdraft or credit card. They've said that there's a lack of competition, and they said that somehow large issuers are charging fees that are either unknowable or not understandable by consumers. There are 4,000 card issuers that compete on every single term for consumers' business. They want to be top of wallet. There are, on average, just 4 cards in every single consumer's wallet. We saw $53 billion of balance transfers last year. This is an incredibly competitive market. Consumers know upfront before they sign up for a credit card the disclosures in a box called the Schumer box, named after Senator Chuck Schumer. All the terms, your APR, if you have a late fee, an annual fee, everything, and then they can comparison shop across all these different issuers. So it's extremely competitive, and by its very definition, this is probably one of the most transparent industries that you can find.
Thank you for that. Mr. Anthony, I think that we can all acknowledge that fees are never fun to pay, yet fees help deter customers from engaging in behavior that may hurt the financial institution or the customer themselves. The fact that we hate paying the fees so much suggests that they are working in the exact way that we want them to, as a deterrent. Would you discuss how deterrence would be affected if financial institutions are forced to offer products and services like free overdraft?
Thank you for the question. You're absolutely right that the fact that we're not enjoying it is showing that that deterrent effect is having an effect. It's shaping and incentivizing our decisions, and that's something that we should want to have in here because this is not a first resort, it's a last resort. And as my fellow witness, Ms. Johnson, had previously said, it's not just the costs in terms of the fee itself, but it's also the cost to our credit scores that have much longer term effects that we want to disincentivize from happening.
Thank you. Also, Mr. Anthony, the recent overdraft proposal from the CFPB only applies to, in the CFPB's words, very large financial institutions, meaning those with more than $10 billion in total assets. Are you aware of any other instances where federal regulators have bifurcated consumer protections based on the size of the institution that the consumer has a relationship with?
No, this is not a common practice for consumer protections. It really doesn't make sense to say that you should be protected here but not there from the agency standpoint. Instead, what it really seems to be is a way to fast track this process, to try to get it as part of the media campaign rather than the actual regulation process.
You know, 2 years ago, we saw the president knowingly sign an unlawful executive order forgiving hundreds of billions of dollars in student loan debt in an effort to convince people that he was doing a good job and that they should vote for him. And here we are, coming up on the general election, and it seems that this president, with some of the worst polling numbers we've ever seen, trailing behind his opponent in the general election, is yet again using the executive branch to do things that he shouldn't do in an effort to buy votes. It's not right, and we need to do everything we can to put a stop to it. With that, Mr. Chairman, I yield back.
Gentleman yields. The gentlewoman from California, Ms. Kim, is now recognized.
Thank you, Chairman. I want to thank all of our witnesses for being with us today. You know, one of my priorities is to help small businesses, families, and individuals from diverse backgrounds to get access to capital and credit. I want to ask my first questions to Ms. Johnson. As you know, the subcommittee has attached the discussion draft on legislation that I'll be introducing that has to do with putting some guardrails for the small dollar loans. Actually, I was very intrigued by this proposal. Can you elaborate on how this legislation can help low to moderate income communities and minority groups in underbanked markets?
So this is an incredibly important product for a lot of consumers who do need a short, small dollar loan to finance, part of their business, to make ends meet for a particular time period. And banks have really seen regulatory whiplash around this over a course of about 10 years. Between the FDIC, the CFPB, the OCC, and the Fed, we saw 19 different actions on this product, really leaving institutions kind of in this regulatory purgatory. And so having the certainty and making sure that it's very clear how institutions can innovate and really try to offer these programs is essential. We do know the need is there. We actually, Pew Research has found that these loans typically cost consumers 15 times less than they would otherwise be paying externally, such as at a payday lender. So they're really important. They're a great tool for banks. Banks typically don't make a whole lot of money. In some cases, they are actually losing money, but they're offering these products because they know it's a great way to bring people in the system.
Right, great. I'm excited because this could really expand access to credit for millions of Americans with little or no credit history. So I'm really thankful that we get to work with you on this. Also, I'm all for protecting consumers while ensuring that they have access to diverse financial tools at lower costs. However, under that leadership of Director Chopra, the CFPB has not conducted proper cost-benefit analysis, nor considered the long-term consequences of price controls on consumer choice. So in that proposed rule of the overdraft fee, the CFPB stated that this proposal will not apply to financial institutions with less than $10 billion in assets. So can you explain why this could be seen as a red herring to justify the proposal? Both Ms. Harbin and Ms. Johnson, you can chime in. Ms. Harbin first.
Thank you for that question. We believe that the trickle-down effect will certainly impact our institution and smaller community banks and credit unions. As the larger banks are forced to alter their prices, we will too for competitive pressure and the market forces, and it will greatly impact our ability to serve our members and to do business.
Yes, I couldn't say it better myself, and we've seen it play out. We've seen it play out with Reg II, where small institutions were carved out, but they still lost about 30% of that revenue. So it'll still be applied, and the CFPB also gave itself an ability to come back and re-examine if it wants to apply this to small issuers. So I think, big and small all know that this is coming for them.
Thank you. Unfortunately, even the CFPB acknowledged that in the credit card fee proposal that consumers would never pay late, we discussed it earlier, that is about 74% of all Americans with credit cards. They will not benefit from the reduced fees, and they could even face higher maintenance fees, lower rewards, or even higher interest-paying account. Let me ask you, Mr. Anthony, on January 23rd of this year, you wrote a piece on how price controls, and I'm paraphrasing here, it can lead to shortages and price increases for all consumers. So in your view, rather than imposing government-mandated price controls, what could the CFPB do to incentivize the market to lower fees for consumers?
Well, thank you for the question, and it's the wrong approach to say that we need to build these barriers up. We need to build greater barriers that make it costlier for businesses to operate and then say that that is encouraging competition. What should be done is quite the opposite. Remove those barriers, make it easier for alternatives to enter the market and then create, through the discovery process, new ways to do business.
Thank you. Ms. Harbin, if your credit union member wants overdraft protection but cannot have access to that service because of the CFPB rules, where will they go to get those extra funds they need or want?
They will go down the street to a payday lender or a less desirable option.
Gentlelady's time has
Time's up.
expired. The gentleman from Tennessee, the home of Davy Crockett and Dolly Parton, is recognized for 5 minutes. Mr. Ogles.
Thank you, Mr. Chairman, and thank you to the witnesses. The great state of Tennessee, but we've heard phrases, the abusiveness and UDAP, the junk fee label. I want to look at or talk about cost structure for a moment. So, and Mr. Anthony, and when you look at the regulatory regime and in terms of compliance or security or even absorbing fraud, is there a cost, yes or no, with that?
Yes, absolutely.
Ms. Harbin.
Yes, a significant cost.
Ms. Johnson.
Yes.
Sueiro?
Yes, but it's complicated.
Yeah. Lots of things in life are complicated, but I do believe the answer to that question is a definitive yes. And when we look at additional regulatory burdens and the implementation thereof, is it safe to presume with that new implementation there would be a cost associated with that? Yes or no?
Yes.
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 And this is for the financial institution or the consumer?
Yeah, the institution, yes, correct.
Yes.
By way of, yeah. So Ms. Harbin, and you alluded to this earlier, so if your fees are going down from, say, 35 to 8, that would result in a revenue loss?
Yes.
And if you are a not-for-profit, you still have to pay your bills, correct?
Yes, we still have to open our doors every day. We have to pay the electric bills, have to pay our staff.
And so, and again, I allude to your previous testimony, so if you have lost revenue in one area, presumably services that are otherwise free, trying to get that underserved customer into the door, you may then have to charge for said services. Would that be fair?
We either would have to charge for services or eliminate the service altogether.
And for your bankers, Ms. Johnson?
Yes, that's exactly what will happen.
So when I think about the business model of your institutions, instead of, looking at credit worthiness or credit risk or the cost benefit analysis of offering a product and the cost thereof, we've heard terms like inclusivity and fairness and equity. Then if we somehow make that the primary function of a business model, that we're going to have Shangri-La and there's going to be rainbows and unicorns everywhere. And I have a simple phrase for you: hippy dippy baloney. It's not going to work. There's a cost to the consumer, and someone somewhere is going to pay. Would that be a fair assessment, Mr. Anthony?
Yes, yes it is.
Ms. Harbin?
Yes.
Ms. Johnson?
Yes.
Mr. Sueiro. Somebody's paying, yes or no?
So there's
Yes
different
or no,
ways.
Mr. Sueiro? Increased costs, somebody's paying, yes or no?
Not necessarily, no.
Not necessarily. Well, you know, I'm not sure of any business out there that can operate a business and not cover their costs and remain to stay open. And so that's the problem, right? The CFPB is an unconstitutional agency that has gone beyond its mandate and its authority. And I previously testified in this subcommittee. I quoted Hamlet. If there was an agency that should, to be or not to be, should die a more painful death, it would be the CFPB. There's nothing that they do that can't be otherwise done by another agency. So it's absurd. So when we talk about junk fees and somehow eliminating junk fees, I think we now understand that there's a real cost associated with that. But yet the Biden administration and failed Bidenomics are claiming that it's going to save American families billions. B as in Bravo. Mr. Anthony, your thoughts?
I think that it's a political move that's going to win support in the short term, but in the long term, it's going to cost people. People are going to get shut out when these things end up being taken off the table, when they end up being denied access, when they end up being denied services. And just like my fellow witnesses have said, not only will it push them to less desirable alternatives, but also right when these things happen, right when you go to pay beyond your means, instead of having that, for example, overdraft protection, you're going to be denied on the spot. So any emergency situation is suddenly turned into hours or days trying to find that funding.
And so I'll close because I just said the last 20 seconds. So if I can paraphrase, the result of these rules and these burdens by an out-of-control agency ultimately ends up hurting consumers. Moreover, those who need services the most, the underserved. Mr. Chairman, I yield back.
The gentleman yields. The gentleman from Florida, Mr. Donalds, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I thank my colleague from Tennessee, making sure that some of the great plays in the world have come back to the hearing today. That was great stuff. Thank you. I gotta pick back up with Mr. Sueiro. That's your name? Sueiro?
Sueiro, yeah.
Sueiro, my apologies.
You're good.
What happens if costs are raised on a bank or any other institution? Who really bears the burden of that?
So when you say costs, do you mean, which costs are you referring to?
Let's put it this way. If there is regulation, or if there is a ruling, or if there is an opinion, let's call it the CFPB, that actually has downward pressure on bank fees, how is a bank supposed to make up the lack of revenue?
So there's a number of different ways. In overdraft and credit card fees, there's a lot of surveys and a lot of evidence to suggest that if you lower fees, you could gain more customers.
Ms. Sueiro, right?
Yes.
Surveys, by who?
By
any of the people that have written these surveys actually run an institution or run a business? Like, so who's put out these surveys?
Well, we know, for example, Morning Consult has put out these surveys, business analyst institutions. We've put out these surveys, Financial Health Network, as well as the FDIC and CFPB.
Okay, so none of these people have actually run an institution. They are just commenting on the operations of an institution. Would you agree with that?
In the case of the surveys, yes.
Okay, so people who do not run an institution are commenting on the fact that if you lower fees, you might potentially get more customers. That's almost similar to the Biden administration saying that if we just expanded electric cars in the United States, people would just buy them. But the automakers are realizing that's not been the case. Would you concur with that assessment?
Well, we know that a lot of financial institutions are actually taking these strategies and having success with them. A lot of financial institutions already offer no overdraft fees and have lowered a lot of their other fees and have gained consumers in the process.
Okay, well, let's do this. Mr. Sueiro, hold tight. Let's go to an expert in the matter, somebody who actually does this. Ms. Johnson, how do CFPB mandates, which are effectively government price caps, close out the market? How does it take away products? What does it actually do to the operations of an institution?
So all those things that fees cover, including the cost of providing the credit underwriting, the cost of fraud protection, the cost of expanding access to other individuals and offering things like free checking accounts, those costs go up. We're at a point in time where we are reaching more underbanked individuals than we've ever reached before in the banking system, something that has been incredibly bipartisan. We're at 96%, and we stand to lose ground on this. We really stand to actually take steps backwards if we lose products like overdraft, if we lose products like credit cards. Those are some of the most important tools that consumers have to actually have access to credit that we all want them to have.
So let's restate. Some of these products are critical for people who are either unbanked or underbanked to come into the financial system. And your testimony is that if the CFPB has their way, they're going to limit those products overall or limit the ability for people who are underbanked or unbanked to be able to access them. Is that correct?
That's correct.
All right. Ms. Harbin, can you elaborate on the compliance costs incurred by businesses while they wait for obviously unconstitutional CFPB regulations to be overruled by the courts?
So I 100% agree with Ms. Johnson on the impact that the CFPB and the rulemaking has on financial institutions. These rules do not happen in a vacuum, and they are one on top of another that put us in extremely vulnerable position to continue serving our members and those with less thin credit scores, marginal credit. So we would either have to eliminate services or charge for services that we don't currently charge for to make up the fees that are lost from these rulings.
So Ms. Harbin, I want to focus this in.
Okay.
So your testimony is that if these fees are limited by the CFPB or the overregulation from the CFPB, it would actually put pressure on your institutions, the ones you represent, to have to actually charge or raise the cost of the products themselves for consumers who are either unbanked or underbanked or new into the financial system. Is that correct?
That's true.
Mr. Sueiro, correct? Did I get it right again?
You're close. Sueiro.
Sueiro, I'm so sorry.
It's okay.
Now, listening to the testimony from the two individuals that actually represent banks that have to do this every day, do you still stand by your testimony?
100%, and I would point to examples in Wells Fargo and Bank of America who have actually lowered overdraft fees and also offered small dollar loans, affordable small dollar loans, as alternatives to overdraft that have worked really well.
Mr. Chairman, if you'll indulge me, you will acknowledge that Wells Fargo is a massive bank. But community banks, by the way, I used to work for Wells Fargo and I worked for a community bank. A massive bank can absorb that. A community bank cannot. I yield.
Gentleman's time's expired. The gentlewoman from Texas, Ms. Dela Cruz, is now recognized for 5 minutes.
Thank you, Mr. Chairman, for holding this hearing today. And thank you to the witnesses for talking about this important subject. And community banks are actually the backbone of District 15, South Texas. South Texas being a community that is 90% Hispanic. So when we're talking about protecting community banks that do so much for rural districts, it is so important that we look at regulation that is going to impact our community banks and not compare them to the Wells Fargo and Bank of America of the world. That being said, I believe that universally both Democrats and Republicans think that this is an important issue and that reducing costs for consumers, I mean, we can agree on that in totality. My worry is that the Biden administration and the CFPB are taking actions to achieve political goals, and that this is not making sound regulations in the best interests of consumers and the markets. The result is that financial institutions in my district are going to face an onslaught of regulatory proposals that are impacting their businesses. And sir, I'm sorry I didn't get your name right now, but I would say that where these conversations need to be focused on are the community banks, are the consumer banks that really do impact Hispanic and minority communities like mine. My question here is for Ms. Harbin and Ms. Johnson. As I said, I represent a majority Hispanic rural district. My constituents in my district, they're working class, they're hard workers trying to put money into bank accounts. It's my understanding that the proposed changes to Reg II may ultimately limit access to financial services for lower income individuals. So as some of these fees that I'm reading here that are charges used to provide low cost or free banking for lower income individuals, is that true? Will these regulations impact families like mine in District 15?
Yes, absolutely. We've seen it, and again, the Fed, the GAO, a number of academics have used the data points that we have over the last 10 years to say when we reduced debit interchange last time, we saw free checking accounts decline by 30%. We saw monthly maintenance fees increase by 100%. The burden of that, 70% of that fell on low-income and middle-income individuals who don't have enough in their account. They're actually the most costly accounts to bank is when you have a very low balance. So typically when we're using these fees to try and offset that cost, when you reduce those fees, that cost gets borne again by that consumer.
So consumers like in my district, would you say that they may potentially become unbanked due to this? Would that be fair to say?
I think there is a good likelihood that they would. We would no longer have the funds to support more marginal credit risk because of the losses. So I think that's a very good analogy. I also think, we are a low-income designated credit union, and that means that over 50% of our members are in a low-income area. So that would definitely hurt us as far as being able to service those members.
So what are some other impacts that may be felt if this change goes through? Will financial institutions be able to offer the same level of things like fraud protection?
No, and that is absolutely one of the biggest concerns that we've got, is because we've seen fraud costs just skyrocket over the last several years since the pandemic, frankly. And the ability to offset those costs is going to be paramount for every single institution, big or small. And so, again, that compression of fees just becomes much more difficult to do that.
So what I'm hearing is the CFPB through Reg II, these regulations are going to impact the very people that they're saying that they're going to protect, which is minority communities, rural communities, and low-income communities. In my opinion, and that of many people on both sides of the aisle, can agree that we want to protect those most vulnerable. And the CFPB, by putting Reg II in place, will greatly impact those in my community and all around the United States. Thank you. With that, I yield back.
The gentlelady's time has expired. I'd like to thank our witnesses for their testimony here today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses please to respond as promptly as you are able. With that, this hearing is adjourned.